What is the difference between deferred tax and current tax? Let us understand. Whenever a business makes profit, it is also supposed to pay taxes. Let's say the prevailing tax rate for some understanding purpose is 30%. So we tend to think that whenever a business makes profit, it will pay 30% of the profit as its taxes. But in reality, it may be different because of tax provisions. We may think that business will be paying 30% of the profit as taxes, but in reality, it may be paying less tax now. But ideally, it should be paying 30% of profit, but why it is paying less tax now? Thanks to tax provisions. But we know it should pay 30%. It has paid less. So what does that mean? It will pay balance in future. There can also be another scenario where the business is supposed to pay 30%, but because of the same tax provisions, it is actually going to pay more tax now. In those cases, it is paying more tax now, and because of that, it will save tax in future. Whatever it has paid more, it is going to save that in future. So here, if you look at this, whatever the tax it is paying now, whether it pays less or whether it pays more, whatever it pays now, they will be called as current tax. Whatever it is paid in the current year or payable for the current year will be called as current tax. And whatever that is getting adjusted, look at this. Here the entity is paying less tax now. It means it is going to pay balance in the future. So there is a difference, right? So whatever that is getting adjusted for future period, we call it as deferred tax liability. We are calling this as liability because less tax paid now, it means balance is payable in future. Similarly, look at here. Here the business is paying more tax now, and because of that, it is going to save some tax in future. So that difference we call as deferred tax asset. So in first case, it is deferred tax liability. In the second case, it is deferred tax asset. So current tax means the tax that is paid or payable for the current year, whereas deferred taxes are those that are related to future period, and they may be in the forms like deferred tax liability or deferred tax asset. To understand this better, let us take some numbers. Look at here, business has made a profit of 100 crore. Assuming 30% tax rate, this business should ideally pay tax of 30 crore. But because of the tax provisions, let's say it is going to pay only 20 crore. So now we need an understanding, because we know ideally this business is supposed to pay 30 crore only, and because of the tax provisions only it is paying 20 crore. It means there is a difference of 10 crore which this business has saved in the current year, or we can say it has deferred in the current year. It is only deferred, it is not saved. So what does that mean? Whatever that is deferred now will be paid in the future. But if you look at the financials of this business, they'll be showing the current tax as only 20 crore, but you know it is actually 30 crore. So how do you accommodate the remaining 10 crore? Accommodate the remaining 10 crore in the name of deferred tax liability. So you will be showing 20 crore as current tax and 10 crore as deferred tax liability. We call it as liability because it is not yet paid. So it will be shown as a deferred tax item in the statement of profit and loss, and it will also figure in the balance sheet as a deferred tax liability under liabilities. So in this way, this 30 crore is given due effect in two different forms. So this is with regard to deferred tax liability and current tax. Let us also look at deferred tax asset. Look at here, they made a profit of 100 crore. Ideally, they should pay tax of only 30 crore, but thanks to tax provisions, this entity is forced to pay 40 crore. It means they are paying more tax now. Why I am saying they are paying more tax now? Because they are supposed to pay only 30 crore based on the profits, but they have paid 40 crore. It means they have paid more tax of 10 crore. So this 10 crore, whatever they have paid excess, will get adjusted in future tax obligations for sure, as long as there are legal provisions supporting that. So even though this entity has paid 40 crore as current tax, it is not their entire tax obligation. Their tax obligation is ideally 30 crore. But as per assessment, it is 40 crore and they cannot deny that they have to pay. But when the readers of the financial statement look at it, they should not get worried at this big number of 40 crore. They should know that this entity is actually supposed to pay 30 crore only, but because of the tax provisions, they are paying 40 crore. So how that can be communicated to the readers? It is by providing for the excess amount that has been paid in the name of deferred tax asset. So whatever the 10 crore that is paid excess, that is 40 minus 30, 10 crore, that will be considered as deferred tax asset and it will be shown as a credit item under taxes. So under taxes there will be a current tax of 40 crore which will be an expense item, and this will be shown as a deduction item, that is deferred tax asset. So what is the impact? 40 minus 10, overall impact is only 30 crore. Even though they have paid 40 crore, this 10 crore will be shown as a negative item. So net effect of 30 crore is only given. So in this way, the readers of the financial statements are given a right picture of the tax effect. So look at here, 40 crore will be shown as current tax and 10 crore will be shown as deferred tax asset, and it will be shown as a negative item, and it will also appear in the balance sheet asset side. Now let us understand both the scenarios and how it is helping the readers of financial statement. Look at the first scenario where the profit was 100 crore, current tax was 20 crore, deferred tax was 10 crore. So we were able to calculate profit after tax as 70 crore. Now imagine a scenario where this deferred tax liability is not at all provided. Since there is no cash outflow, entities can take a stand that why I should provide for deferred tax. If they are taking this stand, what will happen? In that case, profit 100 crore, current tax of 20 crore only will be deducted, and that will result in profit being reported as 80 crore. So this will give an illusion that this business has made 80 crore profit, but we know their tax obligation is 30 crore, out of which only 20 crore is provided for. So that is misleading, right? We know it is 30 crore, but what is captured or provided here is only 20 crore. So here the profit after tax is inflated by 10 crore. So that is not correct. That's why deferred tax liability is provided. Similarly, look at this scenario where there was a excess tax, because this business ideally should have only 30 crore as taxes, but they paid 40 crore. But that excess is offset by providing for deferred tax asset credit, and profit after tax is maintained at 70 crore. If this deferred tax asset is not provided, what would have been the scenario? If that was not provided, then 100 crore minus 40 crore, profit after tax will be 60 crore. Now this will send a signal of worry to the readers, because when they look at the profit after tax, it is very low. But actually their profit after tax should be 70 crore. It has become 60 crore because of some additional tax paid in the current year to the extent of 10 crore, which can be adjusted in the future. It is not a non-adjustable item. So that should be brought to the notice of the readers, and this 10 crore adjustment does that. So here profit is not reported at 60 crore, it is reported at 70 crore. So in this way, deferred tax treatments are helping the readers of the financial statements and analysts to have a clear profitability picture of an entity. So now we'll conclude this with understanding of differences between deferred tax and current tax. Deferred taxes are calculated following the provisions of accounting standards, Ind AS as the case may be, whereas current tax is calculated as per income tax provisions. Deferred tax basically arises on account of timing differences. As I told you, in the current year you pay more taxes, but in future that is going to be reversed, or in the current year you pay less taxes and the difference will be paid in the future. So we call that as timing differences. Whereas current taxes, they arise on account of tax provisions that are relatable to the current year only. And deferred tax may not involve cash flow immediately, because it is basically an accounting entry made to give you the fair position of the picture, whereas current tax will involve cash flow as long as the current tax is paid. Number 4, deferred tax is going to have impact on the future period. Yes, the deferred tax liability created in the current year will get reversed in the future. Similarly, deferred tax asset that is created in the current year will get adjusted in the future. So it will impact the future period, whereas current tax will have impact on the current period only. And in deferred tax, we have subclassification as deferred tax liability, deferred tax asset. Under current tax, what we have is only current tax paid or payable. So that's about difference between deferred tax and current tax. Thanks for watching this video, and if you like this, then do not forget to follow, comment and share. And here we go. Credit and Financial Analysis Mastery Course. It's a comprehensive pre-recorded online course that comes with 15 modules of video lectures, basically 70 plus hours of video contents, multiple ebooks and reading materials related to credit and financial analysis that will make up another 30 plus hours of content. So totally it is 100 plus hours of learning resources. Then you will also get access to a private community in Telegram for clarifying your doubts in credit and financial domain. Then you also have the flexibility to choose 1-year subscription or lifetime subscription depending upon your learning goals. So by joining this course, you will learn basics of credit analysis, how to read balance sheet, financial ratio analysis, cash flow, fund flow analysis, how to arrive at credit risk rating, how to prepare CMA report, cash budget, how to assess credit facilities like CC, OD, LC, BG, term loan, how to write bank loan proposal, and you will also have access to case studies related to credit analysis. So to join this course, to know more about the course, comment CFA, and I'll share the details with you.